Welcome to the Dividend Talk podcast, episode 70. Earnings season has started. Hey guys, welcome back to another episode of Dividend Talk. This week, we're going to chat to you about 4 European companies who released their earnings or sales update. We're going to review portfolios, and then we're going to answer questions from our community from Twitter and Facebook. So let's get started. See you on the inside. Hey, European DJ. We're a little bit late this week, but good to see you.
Yeah, definitely. And what a day it was. I mean, there was some football on TV, and I just learned from you that Liverpool beat Manchester United with 5-0. Do you think this will be the end of Solskjaer, or
I, ho-
was Liverpool just that good?
I hope not. You can see the smile on my face. I don't think I've smiled this much, but, I have to say Liverpool were not even that impressive. We were United are just really bad at the back, and I think we were 2 or 3 goals up before they even started getting into the game. It was way too late. But I really hope Ollie stays at the wheel, because I mean he has not got a clue what he's doing. Let's be honest about it.
Yeah, and if you want to be champion, you need stupid people on the other side, right?
Look, it just keeps them hovering around mid-table. So I'm absolutely ecstatic, I have to say.
It's interesting because Manchester has been really a graveyard of effectively of coaches after Ferguson left, right? It's
Yeah.
like almost like some CEOs at some companies.
I mean, look, they're like Liverpool, but after Liverpool was successful, and we had nearly 30 years where
Yeah.
we were just in a plateau. So hopefully they have another 20 years to go. Sorry to all the United fans, by the way, but honestly, I'm just
It
so
is like
happy.
it is.
I'm so
I
happy.
just watched Barcelona Madrid, and Barcelona's having the same after Guardiola left. Also, like the graveyard of coaches. They lost 2-0, I believe. I didn't watch till the last second. But boy, it's like Barcelona trying to play, but they have nothing in front, right? And these Dutch guys, and I'm a Dutch guy, they are just second grade. I mean, Memphis is not the world star. He cannot replace Messi. The
Yeah.
others can't carry the team. Then you have this De Jong. He's like not even, he doesn't even belong in the D team there. So it's like Barcelona is also, and then all these financial troubles. I mean, it's really like investing, right? If you invest, all these companies, they can live above their means, like Barcelona did, only for such a long amount of time. But suddenly, at a certain moment, like you saw with General Electric, the debt starts to play a role, and then suddenly out of nothing, or not out of nothing, but within a year they can be from hero literally to zero, and we see this continuously. And yeah, I mean, it's exciting now. I hope that some new kind of world order steps up in football. So although I'm not a fan of Ajax, it wouldn't be bad if Ajax climbs the rankings now a little bit.
So if you're new to the show, you might be mistaken to thinking this is a football chat, but it's not. It is investing and related investing. So let's move on to some news in our own world.
Yeah, so what I understood here is that Realty Income now has finally declared the record date of the spin-off on the 2nd of November. So yeah, I was just wondering, like, what do you think about this news? Because you own some Realty Income, right?
Yeah, I own some, and do you know what? I still have to chat to a resident REIT expert, Dividend Dane, to see what this actually means, because I haven't really dug into it a whole lot. But I know that we get, is it 1 share for every, is it 6 or 10 shares of REIT income? We'll get 1 share of the new spin-off. So look, it'll be nice to have some extra shares of something else. I don't know if I'm going to sell or buy it, but it's interesting. It's just going to happen so fast. I think they declared November the 2nd is the record date, and then it'll be completely spun off then on November the 12th. So it's only around the corner. We'll have our new shares in Orion. I think they're called. Is it Orion?
Yeah, and they also reported. I haven't seen the latest news from this week, then, right? That going through the full details, but I remember they also see that they can hike the dividends with 10% or something like that, if I remember correctly.
Yeah.
So I'm also curious about that one, if they really do that. I think I own like 70 shares or something like that, so I could always earn some more.
Yeah.
So I'll keep a really close eye on this one, because I might pull the trigger again still this year.
Yeah, so I assume then we're going to see a drop off in share price for realty income after this.
Hmm.
So
Yeah,
it might present a nice buying
buying
opportunity as well
opportunity.
for people.
Super. So hey, it was also crazy earnings week this week, and it was not the craziest because next week will be totally crazy with big tech and everything. And but we have already some really nice earnings, and yeah, let's look into some. And actually, when I saw the notes for the show today, we are talking about four European dividend growth companies. Yeah,
Yes, yes,
non-American,
yeah.
just pure European dividend growth. So if people are lacking a European flavor out there in the community, then listen to the really stick around in today's show. But at the same time, follow us on Facebook at the Dividend Talk Facebook group. It's really starting up, it's growing. So just join us there. And yeah, tell me, EMF, what was the first company you want to discuss today about?
So believe it or not, I've picked two Swiss-based companies this week. The first one is ABB, and look, before I start, these companies based on the Swiss stock exchange, there's so many I really want to buy, but it's this dividend tax that is killing me. It's absolutely killing me because it's 30%. So if there's a way that I can get involved in these, it's something I'm gonna have to explore because looking at ABB's results, I know we did a show on these before, and I love what they're doing, particularly the robotics section. It's close to my heart. But if we look at how they did again, their orders were 7.9 billion, which I think was level from quarter two, but still up 29% from last year. Revenues was 7 billion, and that was hugely impacted actually by supply chain issues and this semiconductor shortage that we're having. So it's still quite impressive that they were up 7% over last year. Their income from operations was 852 million, which is kind of flat from last year. But the basic EPS was down, so it's down 85%, and I'll go through why in a little bit. And they're just a cash flow machine. They're just generating free cash flow consistently. So, I mean, looking at the results, it kind of paints it's a mixed picture. So on one hand, we've got lots of growth, we've got lots of revenue, and then you got these supply chain issues, and you've got this semiconductor issue that's kind of hampering them at the moment. But in one way, it's helping him because I feel like companies are making orders and they are doubling down on those orders. Because if I'm a company and I need something at the moment from ABB and I know there's a shortage, I'm going, oh, damn, I need to order too. Because what if we run into this problem? So I feel like that their strong orders is been helped by that, but then they can't transfer that into revenue because they can't actually sell it at the moment. So there is those constraints. Um, looking at some of their progress, they have said that they are going to divest the mechanical power transmission for 2.9 million in cash. I think that's a great move. And on the back end of that, then they are acquiring a more robotic company. So they're acquiring ASTI Mobile Robotics Group. So I think that's a really smart move. I know mobile robotics is becoming huge. I'm not overly aware on ASTI, but I do know of MIR that Teradyne own. I know them purely because we use those robots. So I'd be interested to actually dig a little bit deeper into these to compare them and see which one I'd rather work with myself. But it,
Yeah.
it seems like a really strong move for me because I can see the potential translating into my
Mhm.
into my own work. Um, they have been acknowledged. I suppose they keep going on about their sustainability efforts, which we know is huge in investors' minds. They've been ranked 4.2 out of 5 in that scale, so they're doing lots and lots of positive things. So I'm really like if I was a shareholder, I'd be really happy with this result. I suppose for me, I'm not involved in them, but uh, they're just doing really great things.
So for me, ABB, I really like these companies. Like you say, when people are thinking about industrials, they typically think about 3M.
Yeah,
But if you think about European ones, I think ABB, Siemens are really the two powerhouses to consider. I own some Siemens already, and I can tell you ABB is high on my list for if it really has a pull down. The stock price was running up already into the earnings, but
yeah,
then after the earnings, it dropped again back to where it was trading in the end of September. So for me, it should drop a little bit down more. I would be interested around 3% yield. Call me a buyer also at this
Yeah,
dividend tax. I mean, think about it. After a few years, if these dividends are substantial, I would just request them back, right?
yeah,
It takes a bit more effort, but I'm not going to, how you said, withhold myself from investing because of the dividend tax. Yeah.
yeah. And where I'm caught there is you say if it's substantial, it's probably not going to be substantial enough for me to be worth my while. Even if I bought 100 shares,
Yeah.
it's not substantial enough. I did mention it earlier that their earnings per share dropped by 85%. And the reason for that was because last year they had a bit of a kick from the divestment of Power Grid. So last year's was more diluted than this year. So this year's is more of a real figure. So I'm not too concerned, about that. The margins are going up, which means they are making more money, which is always good. Always good. They're able to generate more profit, and their net debt is continue to. I mean, it's incredible. They're just
Yeah.
continue to keep that down. So, really, really strong company. Share buyback program, increasing dividends, strong cash flow, no debt. I mean, they
Yeah.
are
Really
probably
nice.
the four things that I really want. And actually, we talk about European companies the way they are, not European, US companies, the way everything is laid out probably the same in 10Ks.
Mhm.
I really love how they lay out these reports. It's clear, it follows the same format every time, and you know exactly what you're getting with them. So,
Exactly.
top class company.
Yeah. So maybe to come back to this substantial, just really quickly, I look at it like that, not a single company, but I own already some other Swiss companies. And let's
Mm.
assume that in 4 or 5 years, it gives me, I don't know, 1,000 euros per year, 1,000 Swiss francs.
Yeah,
It's worth it to reclaim the taxes for me at that time.
yeah,
You spend an evening on it, you submit the files, and you can get it back. And that's how I look at it. And you don't need to do this every year. You can do with most of these countries, you can do it once in 3 or 4 years. So it's really not a big thing if you're really a serious dividend investor here, trying to be financially independent, because you need to have so much in dividend income, let's
yeah,
say, from few companies to make it really worth it. Okay, but cool. Well, that's about ABB. I think we both are kind of, I said, flirting with this company from what I hear.
yeah,
So on a pullback, call me a buyer or consider me a buyer. What I've looked into actually is Uniliever because it's one of my bigger positions. And if you look at Uniliever, they don't give full updates around cash flow and everything, right? They just give a sales update. What I really liked about how is it their results at this moment in time is that they had an underlying sales growth of 2.5%. But what they were really able to do was passing on the price inflation because the growth came for 4.1% out of price hikes, which had in return also a 1.5% decline. Now people think like, okay, but they don't have organic growth because of that. Honestly, that's not what it is about. Of course, there's price elasticity, right? So if you hike the prices, yeah, you get a little bit lower volume. That's to be expected.
yeah,
Overall, they grew sales, and at the same time, they were able to pass on the inflation cost. This is really important. This is what you want to see in an inflationary environment, because if they weren't able to pass it on, like some other consumer staples we have seen last quarter, you really
yeah,
get in trouble as a company like Uniliever. So overall, this was already for me the highlight in Uniliever. There's also a video that I put on Twitter where the CEO was talking about it. So it gave me quite some confidence in something that I needed because Uniliever during the pandemic as well did well, but they were not outperforming. They were not like P&G or Nestle. I find Nestle at the moment much stronger, although I don't like Nestle that much as a company. But
yeah.
I must say, over the last year, for me, Nestle has been much doing better. So all the credits to them, and specifically in Nestle also with their how I said, with their growth in nutrition and such. And I believe that Unilever is a bit too slow in their portfolio. How I said, management, like dropping, adding some new. Although here as well, both prestige and beauty and the functional nutrition business units were growing with double-digit numbers. So generally it's good, and probably the after the price inflation, my second biggest highlight was their e-commerce, which has been growing with 38% and is
Wow.
now 12% of their sales. this is really nice because it slowly starts to become significant for the company. And what is also nice with e-commerce, you start to really skip some of the middlemen that are taking a share of the
Yeah.
profits in the supply chain, right? So overall, decent numbers, not perfect, decent. Some good confirmations about being able to pass on inflation. That's how I look at Unilever. We'll need to look at the full year earnings in January next year to see what the true earnings power was of these sales numbers.
Yeah, yeah, and that's probably one of the more annoying things about European companies is normally in quarter two and quarter three you get sales updates, which will tell you if their sales are growing and what they expect, but it doesn't give you the real full picture. So it'll be interesting to see how they perform. But like you, I'm delighted reading about their e-commerce. I think that's really impressive, and if they can grow that a little bit more, we should start to hopefully see it reflect in the share price as well.
Exactly.
Okay, so the second company I mentioned, I had another Swiss company, which is Roche. Um, they, like Unilever, they only give a sales update, and straight away once you read the sales update, in the very first line, they have guidance raised from low to mid single digit to mid single digit, and that alone tells you what they are expecting. They are performing better than expected, and they've increased their guidance because of that. So I'm really, really happy with how they're performing. Diagnostics again is knocking it out of the park. I think this is, I don't know, the fifth or sixth straight double-digit growth in a quarter. It's doing really strong, and that's despite a high base from this time last year. We know COVID helped with that, and they were starting at a high base, and they still hit, I think, 18% growth in this quarter, which is really good. The most positive thing for me is the pharma growth. It's been a lot slower. We know biosimilars are really, really killing the big drugs. You're looking at Avastin, you're looking at Herceptin and Mabterra. They're three big drugs from, and they're being absolutely crucified by biosimilars. But on the flip side, you've got new medicines or new drugs making up 50% of the pharma sales. So they've got a really, really strong pipeline. New drugs are coming in, taking over the old drugs, which is what you want to see. And they're just managing it, I think, really, really, really well. They have also said that they plan on increasing the dividend in Swiss francs, which is good. I think that will be their, is it 26, 36 years maybe growth. So they're really, really positive in that. And they've also said that their core EPS growth is broadly in line with sales growth, which we know has increased. So we're looking at about 7 or 8% growth in that over the full year. So I think they're doing really good things. The pharma one is the standout performance for me, but then diagnostics is killing it as usual.
It's really nice to see, right? Because it's one of those companies that has both pharma and diagnostics. So it competes
Yeah,
with, let's say, the likes of, let's say, Bristol Myers and such, and at the same time also with Medtronic.
yeah,
Medtronic. So, and I think this has really been helping them over the last year because the COVID-19 tests really, filled the gap for the pharma business who were not able to treat enough patients, right? Because the ICUs were
yeah,
closed for it. So
exactly.
it
Yeah,
just it shows the power of diversification as such a holding company that Roche is.
really. Yeah, and look, they do talk about their good development of future pipeline, and I have to admit I'm not an expert in this, so they have lots of jargon there that I really don't understand, but they seem quite bullish on it, and you know what? I believe them because of that, because of how they performed at the moment. I believe everything their management says at the moment. So I think
Mm.
it's a really, really nice company.
Yeah. Super. Well, the fourth company then that I would like to talk about is L'Oreal. Um, Fucking hell, eh? Growth acceleration over 2 years, 14.9% like for like in the third quarter compared with 2019. I mean, how much lipstick can you sell? It's unbelievable, right? It's unbelievable. For me, I mean, if I see these sales, like also compared to last year, 23.2 billion euros, 18% like for like with last year's, 18.8% at constant exchange rates. I mean, damn it. And their e-commerce, 29.7%. Yeah. I did a video the other time on L'Oreal. It's way, way too expensive for me. Yeah, because it's priced as as one of those neo EV car companies or something like that, right?
Yeah, yeah.
And but that's why I'm not buying it. But if I see these numbers, it's just amazing. I mean, lipstick and these products, right? Like, is it like Instagram that is pushing this, that everyone wants to look beautiful? Because I mean, I don't understand it, right? Because as a teenager, you can just put an Instagram filter or a TikTok filter.
Yeah.
You don't even need lipstick nowadays.
I mean, the brand power these guys have is insane. Absolutely insane. And I know it was the kind of capitalist who really, I know he loves this company, and he really pushed them to the fore for me. But I feel like you that they're overpriced, but then I realize I'm absolutely terrible at forecasting prices. So maybe they're not overpriced, and I should just bite the bullet and do what I do with Texas Instruments and buy one
Yeah,
share every now and again, and catch the peaks and troughs. But
yeah,
it's just, I'm like you. When I first heard of L'Oreal, I was thinking lipstick. Come on, there can't be that many people buying lipstick. And then you look at the report and you're like going, damn, there
yeah.
is that many people buying lipstick.
Exactly. And then, to be fair, these are consumer products. Consumer products only grew 2.6% as a division, right? But
Yeah.
professional products, 24% up. L'Oréal Luxe, 24% up. Active Cosmetics, 31% up. And L'Oréal Luxe is a 3.1 billion business. It's unbelievable. Yeah. And the active cosmetics, it's now, what is it? It is at 951. And we're talking here about, quarters. Yeah.
Yes.
We're talking here about a single quarter.
Yeah.
I mean, I find it a pity that don't own L'Oreal, but like I told you, I did the analysis like 3-4 weeks ago. The stock just needs to, still with these growth numbers, still drop 50%. It's heavily overpriced in my opinion, but if we get a stock market crash, I hope I won't be looking into other areas at that moment in time, and I'll not forget to really pull the trigger on L'Oreal. I just need it in my portfolio. It's for me one of the ultimate European stocks.
My promise to you is I will remind you of this if it drops 50%.
That thank you. Yeah, I know you are my best buddy here online, so thanks for that.
So I
Good.
mean, look,
Yeah.
that's been four European companies. I think the four of them have been pretty solid, really good. We always say that American companies are strong, American companies are this and that, but I think we need to start focusing a little bit more on what we have over here. Some of them are value plays, some of them are not, but Europe is definitely not being left behind by our American counterparts.
Exactly. Good. That enough about earnings for now. Let's go to engage a little bit with our community. And really exciting here. We have Brady Neely actually sharing his portfolio with us. So, um, interesting one. He owns 15% in gold, Barrick Gold, 12% in Legal and General, which is an insurance business in the UK. 10% in Kraft Heinz. I think it's a value play specifically after the dividend cut not too long ago.
Yeah.
9% in Visa and 6% in Johnson and Johnson. His 5%, his top five makes up 52% of his portfolio. Yeah, tell me, what do you think about this?
I mean, it's the first time I've seen gold there, and gold is a top position. So I would imagine this is quite defensive. He's maybe a quite defensive investor. I'm not. Oh, look, I'm not overly familiar in legal in general. I know they're a British financial company. You might have a little bit more insight on them, but Kraft Heinz, as you said, probably is a value play, and a good one at that. Visa, we've discussed at length before. Really great dividend growth and growth company, and then Johnson and Johnson is the darling of the dividend growth. So it looks like a nicely balanced portfolio. There's a nice mixture there of growth, dividend growth, and then you've got the hedge then maybe against inflation there with the gold. So to me it seems like a really solid portfolio, and I, I I don't have really too much more to say to that. It looks really nice, and looking at his goal of retiring early, I think he's well on track for that.
So, yes and no. Of course, he's on track, right? But he has 52% in five stocks, which is
Yeah.
quite concentrated. So I assume this is not his final composition. because in that case, I find too much risk in here. Specifically, when you think about dividend growth, you need to know that 15% is not already giving any dividend growth here because it's gold. Yes, so that's already quite a chunk
Hmm.
out of the portfolio. When we look at legal in general, I looked into this stock when I was analyzing Chesnara. I chose to buy Chesnara at the time for a 9% dividend yield because they are more committed to growing dividend than legal in general. So having 12% in that, I would like to understand what Brady's goal is of having this company. Is it a dividend growth play? Is it a high yield play? Personally, I prefer Chesnara here because of they are like a realty income kind of company, doing it for dividend growth investors. Kraft Heinz for me doesn't fit in a dividend growth portfolio if you really think about it, unless it's really a value play. But then I wouldn't call it dividend growth, but rather as a value investing. From that point of view, I can see why he invests in it. Visa, Johnson Johnson. I mean, Visa position is really beautiful with 9%. Can't say anything about that. Johnson Johnson as well. So I'm just a little bit more, skeptical on the top three. But yeah, Brady, it will be good for me to understand a little bit, probably around legal in general, and a confirmation whether Kraft Heinz is a value play or a dividend growth play. Unless you think like, okay, they cut the dividend, so the only way is up from here. I can understand that. Yeah, I would mix it up a little bit. I would diversify a little bit further to not have such an exposure with the top five of company into 50% of the portfolio.
Yeah, I don't think this is just a pure dividend growth or dividend
No,
portfolio.
it doesn't look like it.
Yeah,
No.
and I think that's clear with Barrett Gold as your top position.
Yeah.
But depending on when he bought these, so if he bought gold maybe in 2018, you're buying gold right at the bottom, and he's got
Yeah.
some nice
Exactly.
price
Exactly.
appreciation there. The same with Kraft Heinz. So maybe there's a bit more value play here than pure
Hmm.
dividend growth.
And
Um,
hedging, like you said.
yes.
Yeah.
So and from that, I think it's quite strong. I know we are pigeonholed in dividend investing and dividend
Yeah.
growth investing, but sometimes it's nice to see guys come in with something else, not just pure dividend, but hedges in other
Yeah.
areas. So I think it's a nice
Super.
portfolio. Yeah.
Good. Well, Brady, I hope it helps or it triggers your thoughts. Let us know also when you want to challenge us back. But thanks for sharing, and yeah, good luck in with dividend investing. And yeah, for now, let's go to some of the other listeners' questions.
Yeah. So the first question is from Ritz. I don't know. You have to pronounce this.
Rits
It's a Dutch.
Wildervank.
It's a Dutch name. Sorry, I won't do it justice. But Ritz has asked us. So he is trying to transition from picking based on conviction to start reading balance sheets, and just looking for some guidance on how we should go about this. So I I get where you're coming from with this. I mean, when you say based on conviction, for me, I get conviction by reading the balance sheets and by getting to know the company. It doesn't happen overnight. And I give you example. I bought Rio Tinto recently. Lots of good things online. European DGI had stuff, but it's not a company I know very very well. So I buy a small position in that company, and what that small position does, it then prompts me every quarter, every year to read their annual reports, to read how they're doing. And then I start to build up knowledge in that company. Are they growing? Are they not growing? And then I can easily get rid of them. But if I have conviction in them at that point, I will start to buy more and more shares of that. So I don't get how you're saying based on conviction and then moving to balance sheets. But for me, that's where I would start. I would pick a company that you're quite happy with on the surface, and then start reading annual reports. You don't have to focus on balance sheets or cash flow. Just read the annual report. You'll get a feel over time. Read the last maybe 3 or 4 years of annual reports, and you'll start to see a trend of what's happening, what the company is saying. Have they actually followed through on what they've said in previous reports, and so on. So that's probably where I would start.
Yeah, and it's interesting what you say. I understand what he means with conviction. I had it as well in the beginning. You hear other investors talking about it.
Yeah.
You look at some of the basic metrics like yield on cost and how you sit PE, and then you start with conviction buying those. But you're really not understanding necessarily what you're buying because, for instance, the debt on the balance sheet and such. So, Ritz, I think it's really yeah, just a really good path to start now. If you're at this stage, just spend some time on it, and it will avoid some basic mistakes, I would say.
Yeah, yeah, and don't rush in and do 10, 20 companies at once. Pick one
Now,
company. Just pick one and
your
build your
top one
base from there.
holding,
Yeah,
just your top one holding, and try to check, is it rightly so your top one holding?
and if it's IBM, sell them.
Yeah, yeah, without a doubt. Don't even read their annual reports. We've done the homework.
It wouldn't be an earnings session without mentioning an IBM. And I have to say, after the last report, I didn't read it, and I know I know you did in some of the dividend day, and we're posting in some of the figures. But they are really messing around with the figures, and Dividend Wave is tracing their debt trail. But then I go on to forums, all dividend forums, and it's IBM or value played by them now, and I'm like,
5% yield. It's a yield trap. That's
Jesus,
it.
yeah, exactly, and it's really concerning for me because you've got all these new investors, and yes, IBM are known as the dividend aristocrat, and they're a darling of the dividend world, but just read the reports, follow what they say, follow how they don't actually follow through on what they're saying, and get to know the company and stay clear. I was one of those up. If you listened to me maybe this time last year, I was one of those buying IBM, but thankfully this podcast has made me look at their annual reports a lot more, and I sold. I got out. I'd like Red Hat to spin off and go somewhere else so I could get involved in them because that's a nice part of the company. But yeah,
Yeah, indeed. Well,
yeah.
let's go to the next question before we get frustrated again. Davide is asking, what would it be your approach when you are in need for liquidity? Would you sell your losers or sell your winners?
Oh my God, that's a good question. That's a very good question. I personally, I would like to think I would sell my losers, but I know myself, and I would sell my winners. I know I would. And I'd be just hoping my losers would come back up, and I won't lose money. That's probably the way I would go.
Yeah. So generally, I would try to let my winners run. That's a rule I learned already over the last few years, and cut off my losers. But of course, I would just look at which company is, let's say, if you have two options here, a winner and a loser, I would just check like which one is the most undervalued, and probably sell or trim the most overvalued here. That's probably what I would like to, what I would do from opportunity cost point of view. Yeah.
Yeah.
I hope it helps, David. Does it make it easier? I
Yeah,
think this answer, because you have two opposing answers.
because I just think as investors, it's and we see this on Twitter. It's easy to throw out stuff and say, "I would do this, I would do this," but when you're in that moment, it's not as easy to do it. And
Exactly.
and
It's in
and
the moment. That's the issue.
yeah, and I have to be honest. I what I would like to do is not how I think emotionally. I think I would react and sell my winners.
Yeah, it makes sense. Next one. Centrino, with all these green weeks, is it a challenge to find good opportunities, or would you suggest to continue to buy every month, or would you pause for a little bit? I will
Yeah,
take this one, maybe, because actually today I find it hard to find good opportunities at the moment, but I'm not going to pause, because then I start, personally, I know this from myself, I start falling into the value investing mindset.
yeah,
I have this already naturally, and it has not done me well over the last years. So what has done me much better is dollar cost averaging. So this week I will have to buy a stock for my monthly savings rate. If I
yeah,
don't do it, I will fall into this value investing mindset trap.
yeah. I mean, we've said this quite a lot on this show, but I think making a plan is the key there. And if you're feeling like you're drifting from that plan, turn off Twitter, turn off Facebook, turn off social media, because that's quite a distraction, and just stick to your plan. And if your plan says buy every month, buy every month. If your plan says only buy when it's cheap, only buy when it's cheap. But I mean, it's just really important to have your plan and stick to it.
Exactly. Dividend newbie, he's asking if we have any investments outside of dividend stocks, and if so, what kind of percentage?
I mean, I used to have crypto. I don't anymore, and it seems to be exploding all around us. It reminds me of 2017. At the moment, I just have dividend stocks, and I'm doing option trading as well. So I do have some stocks that are not dividend. They're more focused for my option trading. I'd love to get into real estate, but that's not possible now. So I just have dividend stocks and my option portfolio.
Same here. Real estate in Poland is just way too expensive at the moment. There's hardly a yield on it. I can better buy some real estate investment trust with a decent yield than buying myself. So,
Yeah.
yeah.
He has a follow-up question as well. I think you answered this last week, but
Yeah.
what price would you consider buying AT&T?
I don't know, $15, something like that.
That's not what you said last week.
Maybe 20.
20, yeah, 20 or 21.
Yeah, but it just tells you it needs to drop considerably, and I would
Yeah.
do it as a value play, not as a dividend growth investment stock. So it would then fit in my 10% part of the portfolio, not in my main part.
Yeah. And you did say that last week, so you're spot on.
Good.
For Dividends has asked us on a recent episode, European DJI mentioned he's not a big fan of Walgreens due to e-commerce competition. How do you reconcile this with owning realty income? He sold all his realty income, assuming banks and pharmacies will dramatically be reduced at some point.
Yeah, I think you might be right. But Realty Income owns more assets than those. It's really well diversified. I think the biggest sector isn't above 10%. And what I like about Realty Income here, it's a slow compounder. We will get like 10 years of information telling us that the business is in decline. We haven't seen this information yet. So we will have ample of time to make decisions once this start happening. That's why I'm more convinced about Realty Income due to the diversity than Walgreens. Still Walgreens, if Walgreens can really well translate into a digital business, into e-commerce, it might become attractive for me. But yeah, that's the main difference here.
Cool. And then the last question of the show goes to Celtic investor. And he says, with a lot of earnings coming this week, which company's results are you most looking forward to, and which company results are you most fearful of?
So I'm really interested in Microsoft, Novartis, Visa, Eli Lilly, Texas Instruments, 3M, Coca-Cola, Chubb, Assa Abloy, BASF, McDonald's, ADP, Bristol Myers, Aflac, Vici, Shell, Apple, Starbucks, Coney, actually, Linde also. And by the way, Total will come as well with major cash flows, I hope. Mastercard is there. Oh, and Altria, as well. What will be the impact of all this patent stuff that's going on?
Yeah.
But also Caterpillar, Baxter, Hershey, and ExxonMobil on Friday, and Chevron, and Novo Nordisk on Friday, and Upfit probably with a dividend hike, maybe 10 or 11%, and ultimately Colgate Palmolive.
Is that all?
This is what I'm excited about. Yeah, where I'm a bit worried is probably Kimberly Clark.
Yeah. Hey, that's a long list. You're going to be a busy boy.
Yeah, so I need to decide which earnings calls. Typically, I go into the Microsoft earnings call and then I fall asleep halfway because it's usually past midnight then. That one will be on Tuesday. So on Wednesday, I'll probably take the call, at least listen back to the one from BASF because I've been adding there over the summer. On the 28th, I will definitely listen to the earnings call of Shell, and I'm expecting, well, maybe not too high cash flows because they did a press release the other day, earlier in October, saying that they had some impact to the cash flow. But we spoke about that last week. I think better now because this is the time to put all your trash into the cash flow.
Yeah.
And I think they're doing that. But also ExxonMobil, because for ExxonMobil, for me, the question is on Friday: will they hike their dividend? Because if they don't do it, they will lose aristocrat status.
That is the question. I'm sure they will. I'm sure they will. Even 1 cent. I'm sure they will.
Yeah.
Okay, that was a nice long list. I'm not even going to attempt to follow up with that. I think we have enough tickers there. But again, thanks to everyone for the questions. Really enjoyed them. Lots of thought-provoking ones there as well. So we appreciate them. And don't forget, you can drop us questions on Twitter or Facebook. We take them from both places, and we'll try and answer as many as we can each week.
Thank you then. And I believe also we wanted to at least take a stock pick today again. And it's, I think, a company you recently bought. Could you share a little bit more about that?
Yeah, and look, definitely this is not a recommendation, but it is a company that I bought this week. They are called Vitaris. So they are formed recently after a spin-off between Pfizer's Upjohn business unit and Mylan. So what I really like about this type of company in my portfolio is that we speak about ABV and we know biosimilars are having a huge impact. I spoke about Roche and biosimilars are having a huge impact. So I was thinking to myself, if biosimilars are having a huge impact, why not invest in a company that makes biosimilars? And this is a company that will do just that. Mylan has had huge experience in this area. They bring a wealth of experience to this company. So I'm on that side of the fence. They do have some brands which do quite well, but they make most of the money from biosimilars. One word of warning though is that they are quite new. Mylan had a shit ton of debt that they had to bring over, so it's a highly leveraged company. But if you look at their competitors, like Amgen, for example, these are dirt cheap. I think they're trading below maybe 3 or 4 PE ratio. They could easily be 7, 8, 9, 10 PE at a minimum for me. So it's more of a value play for me. They have paid a dividend. They have said they're going to increase that dividend where possible every year. The debt does concern me. It concerns me a lot, but uh, they're I think they make a lot in sales. They're cash flow positive. They're reducing that debt heavily as quickly as possible. So it's kind of a hedge against companies like ABV just being on that side. So a little bit of an interesting one for me. As I said, I mentioned before, my strategy, I buy a small amount of shares and then I start to get to know the company. So I'm only beginning my phase in getting to know them and understand what they really do, but it certainly seems like a value play. And if they can reach maybe 7, 8, 9 PE, I'll be after making enough money. I can get out at that stage if I need.
It's a nice one. And actually, you have also Ian Lopuk, who really shares your thoughts here. He was on a podcast earlier, right? Here with us. And he
Yeah,
is also a big fan of Viatris. And I think already for half a year, he's been buying and accumulating into this stock.
yeah. So look, they have some really nice potential. They are making biosimilars for AbbVie's Humira drug and lots of other big brand drugs like that as well. So it's
Yeah.
really interesting to me. As I said, it's a nice hedge against those companies, and I'm just going to start building slowly, getting to know the company. Hopefully, they've only one annual report at the moment, which
Yeah.
was based over a 3 month period or something. So it's not
Mhm.
enough to fully understand the company, but we should start to see how they go over the next couple of years.
Nice one. Thanks. Well, hey, this brings us to the end of the show. Thank you, EMF. It's recorded this time on a Sunday. It was Friday having a party, some family, you as well.
Yeah,
So next time, let's try to do it again on Friday. But yeah, for everyone that stuck so long with us, thank you so much. Don't forget to follow us on Facebook or on Twitter. And yeah, have a great remainder of the week.
yeah. See you next week.